Welcome from me, Guy Munson, to our regular 6-minute strategy summary. As the members of the Federal Reserve's Open Market Committee gathered this week to set US interest rates, they have been trying to read an American economy that's sending out decidedly mixed messages. On the one side, 3 straight months of uncomfortably strong inflation data suggest that progress towards the 2% inflation goal has stalled, at least temporarily. On the other hand, official figures showed last week that US GDP growth was running at an annualised pace of just 1.6% last quarter, a big miss on the 2.5% that economists have been expecting. In the event, Chairman Powell took a middle road at the press conference after the meeting, saying both that it's likely to take longer to reach a sustainable path of 2%, but that it's also unlikely that his next policy move will be a hike. So how should investors react? First, it's clear that business conditions are improving globally, and this is supportive of equities. In the US, where 2/3 of companies have now reported their Q1 earnings, the average beat on analyst expectations was around 9%, and that's a good number. Second, if the US is likely to see stickier inflation than in Europe or Asia, then this argues for dollar strength. This is already putting pressure on the Bank of Japan to support the yen. Indeed, they've probably already done so in some scale. We'll discuss this, the growth inflation dilemma, in more detail in the slides ahead. So let's begin by looking at global inflation rates in the left-hand panel. And you can see the remarkable job central bankers have done. Just 18 months ago, we were looking at near double-digit figures. We're now down to somewhere around 3% worldwide. But those numbers are beginning to flatten. In the US case, that dark blue line, you see that move tick up to somewhere around 3.5% today, and that's what's on Chairman Powell's worry list. Looked at another way, if you take those numbers and annualise them over a 3-month basis, you can see that dark blue line in the US beginning to break away from the rest of the world. And I think that's what troubled the committee. So what's behind this difficulty the US is having in this last mile down to 2% inflation rates? Well, I think first of all, wages have been a bit sticky. That dark blue line, the employment cost index, has begun to tick up a little bit, up to 4.2%. Encouraging, though, higher frequency data, like the wage growth advertised in job postings, is beginning to fall quite rapidly from the very high levels we saw as the economy opened up and re-accelerated. The second thing on their worry list will have been rising house prices. It's not a big move. The Case-Shiller index are up 7.3% year on year, but that'll flow into what's called owner's equivalent rent. What the US statisticians do is to attribute the house price to a nominal a rental cost and put that into the inflation number. At 5.9%, that's still stubbornly high. The third thing I think that will be on Powell's worry list is the prices that factories are paying for their own supplies and inputs, and that's beginning to creep up again in the very well-respected ISM review. Also of worry, I think, will be the gasoline price, which is so key to US consumers, that beginning to tick up to 3.8 or so a gallon, equivalent to a 17.5% year on year, so that's quite a material move. Our own view here, though, is that those inflation numbers will probably start to come back to track, even if this means Powell keeping rates higher for longer. Why are we confident? Well, in our traditional supply chain details we look at in these videos, delivery times at the factory gate are up a little bit, but not too much. Global supply chain pressure index flat. And while we've seen some move up in oil prices, gas prices are still extremely low, and both commodities are lower than they were at the outbreak of the Ukraine war or the tragic Israeli-Hamas war in the Middle East. So what does this mean? Well, the first thing that's happened is that interest rate forecasters have had to take off their starry-eyed spectacles and be a bit more realistic. You see in the left-hand panel what the market is expecting of interest rates going forward. That dotted line, 01/01/24, which is where we were at the beginning of the year, expected the US to have 6 or more rate cuts from 5.25 to 5.5 down to 4%. That 4%'s risen to 5%, so 1/2 cuts. If you look to the Bank of England, today rates are 5.25%. At the beginning of the year, we thought those would collapse down to somewhere around 4% by December. That's now more like 4.8%, 1/2 cuts, the likely number. This is more hawkish, but I think it's more realistic. The bond market's reacted, yields have jumped quite sharply, and while they could still go higher for governments, I think there's real potential in investment-grade corporate debt, particularly the UK, where it's generating yields of around 5.5%. Finally, what will it do for equities? Well, I think a slightly less starry-eyed view of interest rates will mean growth stocks give up a little bit of their leadership and broaden out from the AI tech supergiants that have dominated the index. This means that red line, the equally weighted equity index, could begin to catch up its market cap weighted equivalent. And on the right-hand side, that huge style distortion, where all the increase in values come from growth stocks, could begin to normalise. I particularly like to see dividend yield funds begin to rally, and also more value and small cap. So in summary, I think the futures markets are telling us we're being a little bit more realistic. We're not going to have the size of the cuts that we did have, but Chairman Powell is clear we're not getting a hike. We're probably on an interest rate cutting cycle, but a milder and more slow one than we'd had expected at first. That last mile, I'm afraid, was always going to be difficult. Thank you.